Hello and welcome to the Investor Master Series. My name is James Boyd. We welcome you here this morning. Barbara Armstrong in the chat. We welcome her, fellow instructor as well, and many of you that are live here. We got Bharat, BJ, High Speed, Low Drag, Lisa, Ocean Life, AP 514, and many others. Welcome and good morning to all. Now, we want to hop right into the markets as we kind of talk about some of the things that we're seeing on the charts. Very interesting morning so far. A lot going on, not just stocks, but kind of other asset classes as well. And we'll talk about that, how that's affecting equities. So just real quick, when we talk about an Investor Master Series, think of this as like macro, right? Looking at how the economy is doing, which as we've seen in the last couple of days, does have it can play out in stocks itself. Okay, so how the economy is doing. We'll talk about technical analysis, fundamental analysis, option strategies. We provide this class to really try to bring it all together, okay? Individual pieces that are taught in certain classes, beginner, intermediate level. We want to bring those all together here in this class, which is more intermediate to advanced. So we welcome you. Now, just real quick, as we get started, I want to give us a quick reminder that when and if we talk about options, remember that options carry a high level of risk, not suitable for all investors. It's okay to practice paper trading those type of option strategies. See if it's something you would consider. You can make that decision for yourself. And also remember the information here is provided for general informational purposes only. Also, investing involves risk, including loss of principal. Okay, so really, if you kind of really think about what's the first job of the investor is protect capital, right? Manage risk. And we'll talk about kind of some of the different ways that the investor might try to do that. Now, also remember when we talk about examples, they are just that, and we will use the Thinkorswim paper money platform, and that's the software-based version. Now, also, real quick, when we talk about this class, we really have this format of things that we will discuss. First, I'd like to take a look at the general market, okay? And we'll talk about kind of some of the different asset classes and how it's playing out in terms of sectors. Then we're going to talk about one or two stocks that are going down, okay? And I want to kind of talk about exits. I want to talk about protection and just kind of have a nice discussion on understanding options and how they can provide protection and what types and the management of those positions. Then we'll talk about some positions that are really kind of bucking the overall trend. And we'll talk about some of the ways the investor might try to play to the upside with defined risk. So first off, let's kind of take a look at the VIX, okay? Now, we know that, for example, okay, now I'm a simple person, okay? So I want you to think about when you look at the VIX, if the VIX is rising, think of this as the blood pressure of market participants. So if we actually are kind of in that lower area, okay, over the last little bit, we've been sitting here right around 15-ish. And then if you zoom in, right, the last couple of days, going back to the 19th, maybe, for sure the 20th, okay, then going into the 21st, you've been seeing that the VIX has been increasing. Now, this is very important that we understand this, okay? So if we see the VIX rising, what does that probably mean? Well, this probably means maybe stock exits. And we call it the 1, 2, 3 methodology with whole moving averages. Now, don't worry, I'm going to show you that in just a sec. Second, what else? Well, the thing is, the investor, if they said, well, how do I actually further my investing knowledge? How do I actually try to learn to protect the position in the portfolio? Well, first thing would be, do you have a basic understanding of when to consider using covered calls? Well, yesterday we talked about, for example, using the trend candles. The investor would probably consider doing covered calls when you have orange, purple, color, green candles. Why? Well, that's the consolidation. Why? Because that's actually starting to pull back. Okay? Now, the investor, if they said, hey, the covered call is more of an income strategy. The only protection on the covered call is really the income. If you listen to what we talked about on Thursday, we talked about protection, defining risk. And what was that strategy? Give it to me. Hand it over. Hand it over. What was that? Well, it was really buying pets. And I'm going to put it pets. Okay? Buying puts. Well, buying puts really defines risk. And we're going to see that in just a sec. It's the right, okay, to sell. Now, when does someone maybe consider that? Well, the biggest thing we said is the investor is actually trying to do that when VIX is low and diverging. Now, when you say diverging, what oscillator are you using? Of course, the MACD. Okay. What setting? 817.9, 613.9. If we took an average, probably say 817.9. But if you'd like to see it a little earlier, 613.9 setting to be specific. Okay. Now, if the investor said, look, I want a combination of income and also a right to sell, that would be what type of strategy? Well, that would be a collar strategy. Okay, collar strategy. This is just, if you really think about this, this is a covered call. Okay, and a put. So don't be confused by a collar strategy. It's just combining 2 and 3, the covered call and the long put. Okay. Now, what I want to do is, when we take a look at this, I want to back this chart off for just a second. And when you look at this, sometimes what can actually happen when the VIX goes up like this, people escalate in fear. That's one way to look at it. Sometimes when you actually see this go up, what do you think as an investor? Do you escalate in fear, or are you kind of thinking about, hey, some things are starting to look like potential opportunity? Now, if you were to put on trades historically, when the VIX was at these levels, and you say, man, today I'm going to go bearish, those bearish trades probably wouldn't have lasted very long before the market rebounded back to the upside. Now, does the past mean the future? No. But if we went back and said, okay, we're just going to panic, and we put on bearish trades when the VIX is at this level, 20 or higher, could the market go down further? Yes. Could the VIX go up higher? Yes. But what you're going to notice is when the VIX kind of gets up to this area, let's say over 20, 22, okay, earliest 18, you'd probably say that a lot of the selling damage has been done, okay? Now, I'm not saying that everything's at the low and the bottom, but usually when people sell, they usually sell pretty quickly, as we will see in Amazon in just a moment. So when you look at these charts, when you pull up Dow Jones, etc., that's been selling off. The 20-period moving average has been red for a while, almost a month on the 20-period moving average. We're using the 20-period moving average as an indicator of trend. It's been horrible. Okay, Dow's been struggling. If you look at the SPX, which was doing pretty good until probably last Wednesday-ish, okay, Friday-ish, you're going to see that it even had the shorter-term moving average, okay? And let's label these now. I'm going to tell you right now, we want to kind of make investing, and we're going to talk about kind of management of these positions. But when we say, for example, like 1, 2, 3 methodology, when we see that shorter-term moving average go red, that's 1, okay? This is the earliest sign of selling. If the investor says, I have a lot of positions, or I want to get out of some of those positions, the first day was probably right on the day that I circled. Now, number 2 was when the 20-period moving average went red, okay? Now, on the same day, you also saw that moving average crossover. That's not always the case. So really, if we look at this, and I'm going to assume the very end of the day, on the 21st, I believe that was Friday, there was really all indications, 1, 2, 3, 10-period moving average went red, 20-period moving average went red, and the moving average crossed over. Okay, so if we're talking about waiting for all the confirmation, if you wanted to, Friday showed selling pressure. Are there any questions with that? Any questions with this? Now, one of the comments really came in from Jonathan. What are bearish strategies? Okay, so I would not even think in my mind about bearish strategies until the investor manages what they have in their portfolio. Okay, now if they said, hey, James, I did go in and manage what we had in our portfolio, and I'm now going to consider a bearish trade, we would be talking about short call vertical, long put vertical, okay, as a bearish trade that does not require the stock. If someone says, I have the stock and I want to protect, it could be a protected put or a collar. And if someone says, James, I want to kind of put a bearish trade on the market itself, Well, they might do that through the option, maybe on the S&P 500 or the NASDAQ. That could be through the options, or maybe, as you saw Ben do it this morning, on the future, okay? But the first step is managing the portfolio, the one you currently have, okay? Now, I want to kind of just bring up an example of this, of a stock that is in the portfolio and might be underneath a little bit of pressure. Now, it's so easy to look back and say, well, duh, there was the selling. Well, so I want to bring this up and just kind of tell me, where do you see the selling? Now, I want you to listen to me very closely here. On a stock position, on a long synthetic position, we're going to use the 1, 2, 3 method. Did you just hear what I just said? On a stock position, on a long synthetic position. Why did I name those two strategies? Well, what's the commonality of those two strategies? They're the highest delta there is, okay? Buy 100 shares of stock, 100 delta. You buy a synthetic, long call, long, short put at the same strike, 100 delta. So those strategies are great if it's going up. But if it doesn't go up, if it starts to go down, they're the most riskiest strategies in terms of directional sensitivity, also known as delta, okay? Now, if we go back to this, what you're going to see is, tell me where you see the sell signals. Is there any sell signal yet? Now, why do we bring this up? Because we have SLB. So we want to try to see, can we apply in the moment, sell? Now, I'm going to tell you right now, it's hard for people to make a decision. Nobody tell my wife I said this. But my wife struggles to make a decision sometimes. I mean, I have to kind of tell her 1 or 2 days ahead of time. Just, I want you to be thinking about whatever, okay? Some people just don't like to make a decision on the spot. Me, I don't mind, okay? Now, if you take a look at this, that's number one. So if someone said, hey, I want to sell at the earliest indication, there it is. Now, if someone said, James, I like to sell when I at least get to step number 2, let's see where we can see it together and see if we need to sell this in the paper money account. We go forward and say, do we have number 2 yet? No. Do we have the price below the moving average? Yes. If the price starts to fall down below that 20-period moving average, would you say that the second sell signal potentially could be imminent? Of course, right? Because what's creating the sell signal? Price action. If that price action drops down below the 20-period moving average, we know that sell signal is probably coming imminently. Now, we actually go forth to the next day. What you're now going to see is the 20-period moving average, or we could say in this case, crossed over. So there's 2, okay? There's 1. And if you said, well, where's kind of the third, more confirmation, there's 3. I'm going to tell you right now, if you can count to 3, you got a chance, okay? So if someone said, James, I don't want to get out on number 1 because it's maybe early and there's no confirmation. If someone says, I want to get on number 2, more confirmation, but the confirmation ain't free because the price has to pull back more. And if someone says, I want to try to ride these trends the longest and I'm willing to give back more to just make sure it's really pulling back, it's really number 3. So you get to choose, okay? Now, what you're now going to notice is if we said, well, on SLB, is there a sell signal on a stock position or a long synthetic position? There is reasons to consider exit, okay? Now, here's the deal. Not falling in love with SLB, okay? Now, what you're going to notice is we're going to go back to the portfolio. Now, here's the deal. People will say comments like, well, I'm not really good at selling. I'm not sure if I really believe that. Can you execute what is on the screen? Now, what you're now going to notice is, I'll come up with reasons like, well, I would have liked to sell when the price was higher. And now I'm kind of having second thoughts. I wanted to get $500, but I only have 119. At this point, it ain't about what you want. It's about what? Protecting capital, okay? So if you kind of have reminisce on, I wanted that $500 potential gain, well, that's not what's happening on the chart right now. My second goal is profit potential. My first goal, the investor says, is really capital protection. We're going to right-click on that line, create closing order, and sell. So in someone's portfolio, first takeaway from this class here today in the first 14 minutes, you should be looking at your own portfolio and saying on a stock position perhaps, or on a long synthetic position perhaps, do you have any sell signals? Can the investor execute based on the 1, 2, 3 method? That's the first step. It's not what about bear strategies? Because if you go straight to bear strategies and you don't manage what you have, you're never really executing any sell signals. This is showing an example of a sell signal based upon the 1, 2, 3 methodology. And what we're going to go ahead and do is say sell, confirm send. And it's not to say we're never going to get back in. At just this moment in time when those moving averages are red, that's not really showing the condition that is conducive to upward trending stocks. Does that make sense? Now, if we went back to the chart that we showed yesterday and said, what type of candles are we getting on SLB? We'll show you. If you look at this right now, what color candle do we have? Well, we got a purple color candle, price down below the 10-period moving average, above the 30. That's showing pullback, and it's showing a little bit more severe pullback. If we actually get the price falling down below both moving averages, like we did today, red color candle. Boo. And so if the investor said, well, in that type of situation, I don't want to hold the stock, my number one goal is to protect capital. Now, James, be honest with me. And Bart, be honest with me. Was it always the fact, here's the thing, as you do this longer and longer and longer, you should be becoming better with entries and exits. It's not just about entries. Entries help, but it's also about being as crisp, okay, and disciplined on exits as much as entries. Now, something also kind of situational. Now, we're going to go back to also a stock that we also brought up from yesterday. Is not that one. I don't want to look at that one. Not yet. I want to go back to VZ, okay? So now sometimes, fortunately, sometimes you have some stocks where you say, James, the position that we have, this one is going up. Now, when the market pulls back, it sure seems like you have more bad ones than good ones. Does anybody know what I mean by that? You should, okay? Because the majority of stocks kind of tends to follow, okay? The ones that majority tends to follow the market in general. Now, the other position that we actually need to kind of keep an eye on and watch is on VZ, okay? Now, VZ, you want to kind of be thinking about also, again, we're talking about exits, okay? On this, what we see is we have a long call and we have a short pet. Now, we're not falling in love with the profit or loss. We want to kind of align ourselves to what's happening on the chart. Now, if you first take a look at the position, what is it? It's a long synthetic. I've been hammering for the last 10 minutes on a stock position, on a long synthetic, because those are strategies that have a higher delta. If the stock starts going down, these are the ones that could be the most painful. The second most painful is going to be a cash secured put with no downside protection, because the delta is rising and the volatility is getting higher, which is inflating. So probably the most two dangerous positions when markets fall is a stock position, a long synthetic, similar, and a cash secured put. So if someone said, what type of strategies is the investor really watching when the volatility is rising? Stock, long synthetic, and cash secured put. If the investor is sloppy on those strategies, probably going to pay for it, okay? So I'm just telling you, a lot of investors kind of need to know, what should I focus on? Those three strategies, if you had those, you probably want to make sure that you review what are your exits and protection. Now, if we go back to VZ, what's the idea on VZ? What are we kind of watching here? Well, our goal was that maybe VZ might go up to that 43.88 level, or 44.55 level or so, okay? So what are your kind of thoughts now? Okay, well, now we're kind of starting to get within 1 to 2% of that resistance area. So let's kind of talk about just real quick the management of this. I mean, now we're only talking about if we go up another 70 cents or so, gonna get out, okay? So remember we kind of talked about that reward risk ratio of 1 to 1, 1 to 1.5, right? If we're trying to get that last 70 cents, we're not gonna give back more than 70 cents. What was the highest price here today? The highest price was $43.97. So technically it was about 50 cents. So what we're going to do is we're going to set an exit on that long call. Now listen to what I just said. I'm going to set an exit on the long call. Okay? And wait, why did he just say that? What about the short put? Well, let's go back to that. Help me out here. Why might the investor just consider getting out of this short put by itself? It's an easy answer, because there's nothing left. So what you're going to now notice is the short put sold for 40 cents is at 7.5 cents. If this ever has 80% ever, well, the investor might take it. We're not going to set the conditional exit on this one because, well, in this situation, if the investor let it drop, you're giving back some of the money. And the biggest actually thing is you already maybe have your price target, the percentage gain you're looking for. Step number one, we're going to right click on this, create closing order. We're going to buy it back. And that's confusing, James. Why are we buying it back? Well, because we sold it initially. If you sold it initially, you're -1. The way we get back to 0, you got to buy it. So we're going to buy it. And now what you're going to see is we're going to try to buy it back for 8 cents plus the commission, confirm send the order. Now, to be crisp, okay, on those exits, we're going to go back to the monitor. And what we're going to do is we're going to go back and say, okay, what should be the conditional price to exit the position based upon today's candle? Well, we went up to about 43.97. That conditional exit on the call, we're going to right click on that. That call went from 152 up to 402. We're going to, and by the way, if the call has made more than the short put, that tells us that the stock had a pretty decent move. We're going to right click on that line, sell. We're going to now bring up this order, limit to market. Okay, limit to market, data GTC. Now, on this, what we're going to say in this case is if you go down to 43.50, exit the position. Now, wait, where did you get 43.50? Well, we pretty much touched 44 today. We only wanted 50 more cents. So we were trying to only get 50 more cents. So we're making a 1-to-1 reward risk ratio. We're trying to get last 50 cents. We're going to set the stop down from the highest price that we were. Listen, highest price, but I wasn't there to see it. Doesn't matter. Now, so that 43.50, this is a conditional exit. It's saying if the stock price, VZ, gets at or below 43.50, sell the call. At what? At its current market price. Notice when we type in this number right here, it matches. Verify that it does. We're going to go ahead and say save the order, confirm send. And now what we're going to do is say, look, if VZ gets at or below 43.50, sell the call. Okay? So the first step is to manage your own positions. Okay? In other words, you're looking for positions, stock, long synthetics, cash secured puts that are kind of meeting that 1, 2, 3 methodology. If you have a couple of positions that are up that haven't pulled back yet, that investor might say, I'm going to manage those too. But the biggest thing is taking care of what you have first. Okay? Now, Jonathan says, got to learn these conditional orders. The conditional orders that we're really doing is they're option trades where the exits are based on the stock prices. That's really all it is. Okay? All right. Now, what I want to do now is I want to go back to just real quick. So some quick things I want to point out. Okay? So when we saw, let's say, the market here, let's say the SPX, okay? We know the market is falling, okay? Now, we know that on one side of the pole, you have like income areas. What are those income areas? What are they? Okay? Now, I like to kind of think about it like if I drew this out so we could just follow along. You got on one side income, okay? Now, when the market is going up, people will say comments like, oh, I don't like these areas. They're boring, okay? Well, how that can change when the market drops. So like, yeah, show me that again. Okay, now, growth areas, we're talking about discretionaries. I'll put a Y for that. I'm also going to include technology. Those are the two areas, okay? Y for discretionaries, T for technology. If growth okay, if we start to see market fall, those growth areas tend to become, well, they tend to fall faster, okay, on a percentage basis, okay? They might even lead the selling, okay? So when I say growth, I'm talking about discretionaries and technology. In the middle here, I'm going to label this as kind of more like value, okay? Maybe a little value. And if we look at income, we're really talking about staples. I'll label that as R. I'm going to put RE for real estate. Eva, control yourself. That's for you, okay? I'm also going to include V for healthcare. And I'm also going to include U for utilities, okay? Now, these are the areas, they don't have the same growth rates as discretionary stocks like Netflix, Amazon, Microsoft, Meta, but they tend to distribute more of their earnings per share that is more consistent in the form of a dividend. Now, it's kind of funny that we've drawn this picture 1,000 times, probably at least. But then if you go back to this, what you're now going to notice is, and this is a very important reason why the investor's portfolio, why it's very risky to have someone's whole portfolio in just growth. Because if this area goes down, people are moving to cash, or they're actually moving to these other areas that might be going up. Now, could they be doing both? The answer, yes. How do we know they're actually moving to cash? Well, one of the things that we saw this morning, just keep an eye on this, when you look at the 10-year yield, when we saw worse economic data this morning, we saw the 10-year take a pretty good drop, okay? So when you look at the 10-year yield, this could also be an indicator of people or price level as it dumps, that, for example, that people are willing to actually accept less in return for their money parked in a fixed income product or something like that, okay, or time-based product. So that's the first thing. That's one way to kind of see are investors willing to park some of their money in cash. Some people, it could be a money market. It could be a CD. It could be a bond. It could be a bill, treasury bill, all of the above, okay? Now, the other thing that we actually saw is if you look at some of these areas, we saw when you look at staples, let me bring this back up, staples, consumer staples, that switch, right, from those discretionary areas to technology, it didn't even go down. It went up, and it wasn't just up a little bit, blink to the upside on staples. Now, one of the other areas that's kind of getting a little push, not like staples, we see healthcare, okay? Now, it's not down. I mean, compare this to discretionaries. There's discretionaries, right? Where's technology? Well, if you look at technology, there's technology. So like the diagram is showing, when volatility rises, those two areas, technology and discretionaries, tend to drop. And if you look at, let's say, real estate, the index, that is also getting them a little move. What's the significance here? Well, the significance is not only that it's up, but it's holding the 206 support level. Second, that it's starting to poke, okay, inside this old channel. The old channel was 210. The top end of the channel was really 220-ish, okay? Now, are we saying that the discretionaries and tech are never going to go back up? No. But as long as that volatility is rising, investors tend to be thinking about more about protecting capital. And we talked about kind of some of the ways the investor might consider that. Exiting stocks in general, putting on protective puts, collaring positions, and so on. We'll come to Amazon in just a moment. Now, if you take a look at this, I want to also kind of go back to the one that we brought up yesterday, just to kind of look, just take a quick look. One of the stocks that we brought up yesterday was like Mo, right? Altria. This is kind of in that same main vein of staples. Okay, now we know that, by the way, I'm not poo-pooing people that smoke, okay? When I lived in Kentucky, I helped a guy that owned some farmland in the back and very familiar with tobacco farming, okay? And it's an interesting crop, to say the least. And if you look at that, that's had a pretty nice move here. Now, if I go back to like, well, what's the position, okay? Now, a lot of times when people are, sometimes they're scared to buy, like when markets are going down, they're scared, okay? Because they look at the VIX, they look at the portfolio, but sometimes when the VIX is the highest, there could be some opportunities, okay? Now, what I'm gonna do is I'm gonna come back to Mo for just a sec and just kind of double check, do we have any position? So we have, that position is in the IRA. I wanna go back, if we can, to really, in this case, the margin account, just real quick, okay? Now, the homework assignment I gave you that I'm gonna reapply again, but in the margin account, step number one is we're gonna buy the shares of the stock, all right? Buy the underlying asset, the stock. We're gonna buy 100 shares. Step two, we're gonna go first triggers SEQ. Then, what we're gonna do is we're gonna go out on the monthly options. Why there? Well, tend to have kind of more liquidity. Not all the time, but this is the starting point. If I go look at the 20 to 40 days to expiration, when we take also a look at the implied volatility between 15 and 24, that's kind of more conducive for some investors to consider buying those puts. Now, trade number one here we're going to do here in the margin account is we're going to go long the shares of the stock and at the same time buy the put. Now, when we buy the put, we're typically going to buy the put below the current price. So when we buy, that's typically one or two strikes below the current price. Normally we'll have a delta between 30 to 40. So if the delta is 30 to 40, that's telling us it's out of the money, okay? The delta is stating the probability of the stock being below that strike by a penny at expiration. It's also telling us the approximate gain or loss if the stock were to go up $1 or down $1. The delta does not stay the same. Think of it as the conditional probabilities at this point in time. So what you're now going to notice is that delta is dynamic, okay? It can change based on price, where it's at in relationship to the current strike price. It can also change based upon how much time is left to expiration. That could change probability, okay? But also volatility can change it as well. Now, what we're going to do is once I go first triggers SEQ, we're going to click right on that 60 cent. Now, here's the deal. Nobody wants to buy puts when the VIX is low, typically. A lot of people say, I ain't going to buy puts because I got to pay for them. But when the market falls, it's almost like people are begging, please, please, just let me go back 2-3 days so I can buy some puts. Well, it's funny how that does that, how when the market goes down, now they want to buy puts. Now they would consider it. But that's the whole point. The investor is trying to buy puts when they're inexpensive or less expensive. We talked about last week what that even means. Now, if you take a look at this, we're going to buy the put for about 59 cents. Now, quick math in our head. If we're buying a put for 59 cents and that stock is at 56 bucks, it's like 1% of the current stock price. Now, for some investors, they're thinking it's kind of attractive. Now, the lower the put is, the less the stock has to go up to break even, making it more attractive. But there's still risk. So we just have to understand that when you do a long put, when you buy the shares, the investor is assuming that that value of the put is going to go to zero. The only way that becomes worth something is the stock goes down or maybe goes down by a lot. That's not what we're trying to have happen here. We're trying to have the stock go up in value. So if I go confirm and send, there's not a commission on the shares. There's a commission on the put itself. Okay? Now let's go back and look at something just real quick. Okay? When we go back to the IRA and say, what does this look like in this example? So if you look at this and say, okay, there's the long shares, and where's the put in this case? It's right there. So you got to remember the shares of stock. That's bullish. It has positive delta. The put itself, that's bearish. So what you're going to see is there's the stock. If the stock has gone up, there's a gain on the stock. Why has the put lost? How can the put lose? Well, the put loses, number one, if the stock goes up. Two, you know where I'm going to go with this. If time goes by, it's negative theta. And you also lose on the put is if the volatility rises. Did I say that right? No. The volatility goes down. The volatility goes down like a balloon. It shrinks the premium, okay, the current price of the option, and makes the option price decline. So the investor is okay with that loss in the put, provided that the stock went up to outpace the loss in the put, okay? Now, so we're going to leave it there. Now, what I want to do, so by the way, if you said, James, I'm a stock investor, great, okay? If you said, James, I'm a stock investor, can I practice buying puts when I buy the shares? Yes. Can I, for example, practice buying the shares and then if my position starts to go down, can I buy the put after I bought the shares? Yes. Now, the thing you got to understand something is here is you got to always assess liquidity. You got to say, am I starting off with a position that is liquid to begin with on shares, which will then probably lead potentially to maybe having liquid options. Now, what I want to do is I want to kind of just with that thought for just a moment, I want to just real quick go to the market watch for just a moment, okay? And I want to try to find a lower dollar real estate stock, okay? So if I went to market watch, visualize, okay? And what I'm going to do is I'm going to go look at, let's say, the S&P 500. And when I click on this, I'm going to go down and look for real estate. And if I click right on that, it's going to give me an immediate list. Now, I want to kind of keep in mind when I look at this list, what might be some stocks where we could maybe buy 100 shares of stock, okay? And that's $222. You got this one, 204. You got this one, $100, okay? So I'm looking for, let's say, some ones, BXP, that's 69. So I'm going to look at some stocks where we could maybe consider buying 100 shares of stock. That's in a downtrend. So when we take a look at this, we say, well, we're looking for something that's in an upward trend. Extra Space Storage, EXR, okay? What's the price of that? $162. Now, we're going to have to do this in the IRA account, okay? Now, what you're now going to notice is it has earnings tomorrow. Now, why might this kind of be a little concern? Well, if you're buying the puts on the doorstep of earnings, the current puts might be a little bit more expensive. Now, what I'm going to do is let's just double check this. What do we have in terms of, let's say, the volume on the stock so far? 334,000 so far. If we go look at the puts that are 24 days to expiration, okay, it has an implied volatility of 39. What does that probably tell us almost immediately? Well, if we buy puts, as an example, where they're outside that implied volatility range of 15 to 24, that means the puts are probably going to be pretty expensive. And they are. They're 2 times or 2% of the current stock price. Those puts are 340 and the stock price is 161. We're going to pass on that. We kind of said we like to look for an example where the implied volatility is between 15 to 24, so the puts are cheaper. Going to go back to that. Now, if I look at, let's say, CCI, that's a $95 stock. Let's kind of look and see, is there an upward trend on this? Okay, so there is, and there's been a little bit more of a reversal. Now, the earnings on that is today as well. Now, I'm going to check the volatility. That has a 33 implied volatility. But still, if you look at the out-of-the-money puts, they're still $2 on a $95 stock. That's over 2%. Now, if you take a look at this and said, okay, what do we have in terms of, and let's just bring this up. If I look at this one, what about SPG? That one, if I looked at SPG, it's a bigger dollar stock, but what you're going to notice is it doesn't have entry signals yet on the stock. How are we so sure? Well, on the moving averages, we don't see a green line here, okay? Now, what I'm going to do is I'm going to kind of show you something, okay? Can the investor buy when there's red lines in the moving averages? You can, but you better make sure that the investor has it in exit, okay? Now, what I'm going to do, since these other ones have earnings, if you look at this one, the implied volatility is 25. Now, we can only do this in the IRA, and we're going to have defined risk. So on this, what you're going to notice is we're going to kind of wonder, could maybe, by the way, Simon Property Group tends to be a stock that sometimes tends to lead. Not all the time, okay? Now, if we look at this, what you're going to now notice is we already have 35 shares of stock. Could we buy 65 more shares? That's what we're going to try to do. Now, if I did this, you might think, well, it's going to take a bigger capital position. That's true. But what you're going to notice is we're still going to define the risk. So step number one here is we're going to buy some more shares of stock. Okay? What is that going to do? Well, it's going to push us to 100 shares. Well, the higher number of shares you have, the bigger the delta, the more risk that you actually have. So we're going to cancel that OCO group because that was based upon 35 shares. Step number two. Now, I want to do this because let's say the investor has the shares already. And they're saying, you know, James, I want to maybe buy a put for downside protection. I have 100 shares. How could I do that? Well, first, you're kind of looking for that number be between 15 and 24. The other way you can kind of see the percentage is you can look at the return on risk. Now, this is not perfect, okay? But if you kind of want to just get an eyeball and kind of say, we're just taking a look at the option premium, okay? The option premium divided by the current stock price. Current stock price. And so why do we care? Well, because whatever you pay for the put, that's how much you need the stock to go up to offset the loss potentially in the put. Okay? Now, when we start, we're looking at the options that are 20 to 40 days to expiration, 20, 50 days to expiration, and a delta typically 30 to 40. So if we looked at this and said, well, could we buy those puts for, let's say, in between 265 and 290? That's the idea. That's probably going to give us maybe somewhere right around 275, 280. Now, what you're now going to notice is it's going to show us the percentage, 1.57. 1% would be cheaper, and 2% for our example is going to be the maximum. Okay? Maximum for our example. Now, could someone buy puts that were more expensive? They could. It just means your break even is going to be higher, and it's among other things. Now, to do this, all we're going to do is click on the put that we want to buy. That's it. So click on the put that you want to buy. What does this give us the right to do? Gives us the right to sell the shares at 180 from now until expiration. So guys and gals, this is super important because you got to think about it. Sometimes when stocks fall, it's not the market's fault. It's the investor not really defining the risk of the downside. Stops, they do not define the risk of the downside. It's a trigger to sell, but it doesn't say it's getting out of exactly the price that you type in. When we buy the put at 180, it gives us a contractual right to sell at 180. Now, if I click on this, I'm going to try to go down to that 278. I'm going to go up a little bit more to try to have maybe a little bit better chance to buy it and get a fill. Now, I'm going to go confirm and send. Note the commission there. Send the order. Okay? Now, if we have shares and then we buy the put, we're just applying a protective put to the shares. Now, let's say the investor had 10 stock positions, 8 or 10 stock positions. Does the investor maybe need to buy puts on all of their positions? Maybe not. They might say, James, I'm going to buy the puts on the stocks that kind of really have more lower implied volatility. If the investor says, I have 8 or 10 positions where I have 100 shares, but the implied volatility is higher, they might say, I'm going to maybe consider collaring those positions. That way, there's at least an offset, getting a bigger premium on the call side to help finance or pay for the put. Now, I want to kind of show you something just in closing here. You guys and gals remember our position on Amazon? Remember we talked about, for example, that call that we actually had, that covered call? And on Thursday, we talked about rolling the put. Well, that put has become extremely valuable because as that stock drops and drops and drops and drops below the strike price, what it's really doing is that put has more intrinsic value. So the put on Thursday was bought for $340. But now that put is now $11.82. That put has helped offset the loss by $837, meaning the loss would have been bigger had it not done that. Now, I'm going to talk about this more tomorrow and Thursday, but what the investor might do more now is they might say, James, we still got 24 days left. Could I roll the call again? That's the thought. Because what you're going to now notice is that call has 82% of the premium. So I want us to kind of keep practicing these puts because now as the stock drops, we don't need to be so concerned about delta now because the delta is only at 22. So if the stock drops $1, theoretically loses about $22. That's what's so nice about puts. It's controlling, especially with callers. You really see that the delta kind of stays more stationary. And that's the biggest takeaway from callers versus puts, okay? The delta is not as dynamic. Now, I'm out of my time here, but I wanted to kind of re-practice these puts here today. Your homework assignment, if you said, I've never done this before, I want you to go out and look for examples to buy shares of stock, and then step number 2 is buy the put. If you say, I have done that, then I want you to practice, if your stock is pulling back in the paper money account, practice buying the put. So that gives someone who is brand new and I haven't done it yet, or someone that says, I get that part, I want to practice buying a put. And if someone says, I've done those too, then I want you to practice doing a collar using those trend candlesticks. Now, Cameron May will be coming up next. And I want to actually just say that I thank you for your comments and your questions. And I tried to also answer some of those questions in the body of what I covered here today. Also, I want to thank Barbara here today, also answering those questions as well. Feel free to check out her classes and her X page as well. Remember,